Hello, my name is Paddy, and welcome to the fifth episode of my podcast, Finding Cashflow. On the last few episodes, we looked at equity markets, and specifically the S&P 500. And it is the equity markets that get far more attention in the financial news. They're far more exciting to follow as we get to follow the greatest companies in the world as we follow equity markets. But in this episode, I'd like to speak about a market which is much larger than equity markets, and in my opinion, far more important to the health of our overall economy. In this episode, we're going to look at bond markets and treasury markets. Equity markets are where shares of companies are traded, where shares of companies are bought and sold on the open market. Whereas bond markets is where debt is traded, where debt is created and sold for the first time, as well as resold on the second-hand market. In bond markets, the investors or the purchasers of these bonds loan out their money. And they loan out this money to those selling the bonds, the issuers of the bonds or the issuers of the debt. So we'll now look at one such transaction in the bond market. And I always find it very helpful to look at any transaction from the point of view of one person or one entity in that transaction. This helps me to really see and understand what motivates each person in a transaction. It helps me to quickly see if something would be a benefit or a risk or a loss to that person or entity. And then, in order to understand a transaction more completely, I'll then look at that same transaction from the point of view of all other parties or entities in that same transaction. This is a method that we'll use again in future episodes, as we not just try to understand, but we'll try and predict the outcome of other transactions in other parts of our economy. But for this first example, let's look at an interaction in the bond market from the point of view of the investor, the purchasing the bond. In our actual economy, it is often large institutional investors, such as pension funds and insurance companies, who are the purchasers of these bonds. But in this first example, let's keep things simple, and in order to understand it more completely, let's consider ourselves to be the purchaser of these bonds. So this is me, or you, at the bottom of the screen. We have $100 we would like to invest, and we have decided that we would like to invest this money in the bond market. So essentially, we are looking to loan out our money to someone who wants to borrow this money from us. The other party in this transaction is Amara. Amara needs to raise capital to cover expenses, and she would like to borrow this money from us. In this transaction, Amara will be the issuer of the bond. In our economy, the largest issuers of bonds, i.e. the largest borrowers, would be federal governments, municipal governments, as well as large corporations. And the largest borrower in the world is the US government. And when the US government issues a bond, it is known as a treasury. Now, Amara would like to borrow this money from us for a period of 10 years. So 10 years is the term of the bond. So at the beginning of the term, at year 0, we will loan out this $100 to Amara. And in return, she would provide us with an IOU certificate, also known as a bond, stating that she owes us this money. The bond which Amara will issue to us will outline the conditions of the loan, such as the face value, also known as the principal, which in this case is $100, the coupon rate, also known as the interest rate, which in this case is 4.5%, as well as the issue date and maturity date, which will tell us the term of the loan, which in this case is 10 years, and so on. As the coupon of this bond is 4.5%, this means that Amara will pay us 4.5% of the amount that we loaned to her at the end of each year for the entire term of the bond. So with a bond with a face value of $100 and a coupon rate of 4.5%, we will get paid $4.50 at the end of each year for the term of the bond. And at the end of year 10, when the bond has reached maturity, Amara will pay us our final installment of $4.50, as well as paying us back the initial investment of $100. So this is a very simple example of a transaction in the bond market. But the total bond market is made up of many borrowers who are competing with each other to borrow the money that we are willing to loan to them. So in this example, we have two people, or two entities, who would like to borrow the $100 that we would like to loan out, the $100 that we would like to invest in the bond market. Both Amara and Brita would like to borrow this money from us for a period of 10 years. Just as before, Amara will pay us a coupon or interest rate of 4.5%. And Brita will pay us a coupon or interest rate of 5%. And we will get to decide to whom we loan the money to. Now, as Brita is willing to pay us a higher interest rate, with all else being equal, we'll be more inclined to loan out our money to Brita, because by doing so, we will get paid a higher interest payment at the end of each year for the entire term of the loan. But now let's consider that Amara is the US federal government. And Amara has a long track record of paying back the money that she has borrowed throughout time. Loaning money to Amara has always been considered to be a safe bet. It is essentially considered to be a risk-free investment. In our last episode, we likened loaning money to Amara, i.e. the US government, to loaning money to the Lannisters of Westeros from the TV show Game of Thrones. Loaning money to the Lannisters of Westeros was seen as a safe bet, as a Lannister always pays their debts. And Breda is a brand new borrower. Breda is raising capital for the first time in order to grow and expand her chain of retail stores, selling a variety of products similar to those which were sold by Hudson's Bay. In fact, Breda was hoping to potentially purchase some of the stores which were recently owned and occupied by Hudson's Bay. Breda doesn't yet have a long track record of paying back previous loans, nor does her company have a long track record of earning more money than it spends. Therefore, loaning money to Breda, i.e. purchasing bonds issued by Breda's company, is therefore seen as a riskier investment to make. Knowing this new information, we may now be more willing to loan our money to Amara instead, because it is simply not worth taking the risk of loaning out our money to Breda for the extra 0.5% she is willing to pay us at the end of each year for taking on this risk. So for Breda to entice us to loan our money to her, instead of loaning our money to Amara, she may need to offer us a higher coupon rate or interest rate. Perhaps we may be willing to loan our money to Breda if she were to offer us an interest rate of 7%. So the difference between 7% that is now an offer from Breda and the 4.5% that is an offer from Amara is known as the risk premium. So the risk premium is the yield of a bond minus the risk-free rate. And as Amara is the US government and is seen to be the safest entity in the world to loan money to, the coupon or yield that she offers on the bonds that she issues, known as treasuries, is the risk-free rate. And in economics, when we talk about credit spreads, we're talking about the difference between the risk-free rate versus the rate that's on offer from these corporate and non-government bonds. This spread or premium compensates investors for taking on that risk. It compensates them for loaning out their money to a borrower who has a higher potential of defaulting on their debt. And then these bonds are graded from AAA to investment grade to junk bonds and everything in between. And in times of economic weakness, weaker companies are at a higher risk of defaulting on their debt. And it is for this reason that as we lead into recessions, that credit spreads start to widen, and credit spreads are at their widest during a recession. So now that we understand risk premium, I would like to go on and discuss term premium. But before we do that, I'd first like to have a look at how changes in future inflation expectations has a change on Treasury yields and bond yields. And before we do that, I'd like to first look at the composition of a bond yield. What makes up a bond yield? And in this first example, we will look at the composition of a US Treasury. The first factor which affects these Treasury yields is the federal funds rate. This is a rate which is set by the US Federal Reserve. It plays a key role in shaping Treasury yields, especially at the short end of the curve. It will also have an impact on longer-term Treasury yields. And we will look at why it has a varying effect on Treasuries with varying maturities a little later on. The Fed's fund rate is the interest rate at which banks in the US lend to each other overnight. In Canada, we actually call this the overnight rate. And the Fed funds rate is said to be the base rate for the entire US financial system. When the Fed raises this rate, it becomes more expensive for banks to borrow money. And this increase in borrowing costs is then passed on through the economy, through higher Treasury yields and bond yields, which results in higher borrowing costs for governments, through higher corporate bond rates, resulting in higher borrowing costs for companies, as well as higher mortgage rates to credit card rates, resulting in higher borrowing costs for households. Higher bond yields raises the cost of borrowing, and by doing so, raises the cost of spending for everybody. It increases the cost of money. This is how it brings inflation down. This is why the financial news is so fixated on what the US Federal Reserve, the Bank of Canada, as well as other large central banks around the world will decide to do at their next rate decision meeting. And I have genuinely found it very useful over time to listen to the press conferences of all the heads of the central banks around the world. Jerome Powell of the US Federal Reserve, Christine Lagarde, the president of the ECB, the European Central Bank, Andrew Bailey of the Bank of England, Tiff Macklem of the Bank of Canada, Ueda of Japan, and so on. Future inflation expectations also need to be considered by bond investors when they are determining the rate at which they are willing to purchase a bond. This is because future inflation expectations can either increase or decrease the real yield that investors will make on their investment. The real yield is the nominal yield minus the expected rate of inflation. For example, the $4.50 which Amara will pay us back at the end of each year, as well as the $100 that she will pay us back at the end of the term, will be worth less if inflation is due to be higher than normal over the coming years. As we know, inflation decreases the future value of money. Therefore, in times of higher future inflation expectations, bond investors will demand to be paid higher yields when purchasing bonds. This is in order to be compensated for the decrease in the future value of the money that they will receive in interest payments, as well as when their initial investment is returned to them. In the example we first looked at, with a bond with a coupon of 4.5%, so the nominal yield is 4.5%, if the expected inflation rate were 2%, the real yield of the bond would be 2.5%, which is the nominal yield minus the expected rate of inflation. However, if the expected rate of inflation were to rise to 4%, the bond yield of 4.5% would no longer look as attractive, as the real yield of the bond would now become 0.5%. So we would need to demand a higher bond yield of 6.5% in order to make the same real return on our investment. For this reason, in times of higher future inflation expectations, investors in the bond market will demand a higher yield when investing in bonds. So now we know what a short-term US Treasury yield comprises of. It is based on the Fed funds rate plus future inflation expectations. So if we had a Fed funds rate of 1.5% and an expected inflation rate of 2%, we would have a short-term Treasury bill yield of roughly 3.5%. But if the expected path of the Fed funds rate were to change, or if the future inflation expectations were to change, both of these changes would lead to a change in the overall yield of the Treasury bill. And today was a very interesting day on that front. On today, August 1st, the jobs data coming out of the US were much weaker than anticipated, with far fewer jobs being added to the US economy for the month of July than was expected. There was also a reduction or a revision downwards to the numbers for both May and June. And this caused Trump to fire the commissioner of the Bureau of Labor Statistics. And I'll dedicate an entire future episode to Trump, because I'll have plenty to say about that fella, and I'll need to make sure I keep it appropriate for what is meant to be a family-friendly podcast. There was also subdued market sentiment today, due to the tariff pause having come to an end, even though something coming to an end is normally what happens when a deadline is reached. And this resulted in the market adopting a weaker outlook for the US economy, as well as reduced future inflation expectations. This caused a substantial drop in the US 10-year Treasury yield, a drop of 0.15%, and it caused an even more substantial drop in the US 2-year Treasury yield, which dropped by 0.25%. And a quarter-point drop is substantial. We spent a lot of time analysing if the Bank of Canada would cut by a quarter point this week, which it didn't. And today's move in the US Treasury yield was of the same magnitude. And it is very important for us to understand why today's change in inflation expectations, as well as the expectation of potentially an earlier cut from the Fed due to a weakening labour market, caused a much larger move in the 2-year Treasury yield than it did in the 10-year Treasury yield. And we will cover this in a separate episode, but it is important to ask yourself this question. Why did today's change in inflation expectations, as well as expectations that the Fed may need to or simply be able to cut sooner, cause a larger move in the 2-year Treasury yield than the 10-year Treasury yield? By being able to answer these questions, you will gain a much deeper understanding of how the bond market works. And feel free to put your answers in the comments below. I would love nothing more than to engage in productive conversation about the fundamentals of our economic system. On a separate note, we can also see this reduction in market sentiment reflected in equity markets, which also dropped today, as well as gold prices, which rose. Gold almost always does well when the outlook for the health of our economy deteriorates, although this may not be the case shortly after a very large economic event, where investors may need to sell gold in order to obtain liquidity. But generally speaking, we will see gold rise when worries regarding our economy grow, as gold is seen to be a safe haven asset and has a proven track record of this for almost as long as money has existed. And it is by constantly monitoring these moves in asset classes that I get a feel for how different asset classes react to good and bad economic news. And it is for this reason that I often fail to see why Bitcoin is also considered to be a safe haven asset. Bitcoin is often referred to as digital gold, but on days like today, when market sentiment is poor, Bitcoin often performs more in line with risk assets than it does with safe haven assets, such as treasuries and gold. Remember, when Treasury and bond yields fall, that means that the price of those treasuries and bonds rise. I will show this in a quick calculation for approximate yield to maturity, but we will get into this in far greater detail in a separate episode. If we have a bond which was issued 5 years ago, which had an original face value of $100 and a coupon rate of 4.5%, this coupon rate of 4.5% will lead to a yearly payment of $4.50. And the size of the yearly payment will not change because the coupon rate does not change, even if the bond were to be sold on the second-hand market. The original term of the bond was 10 years, but because we are now 5 years into that term, the number of years left to maturity is 5. So now today, 5 years after this bond was issued first, due to the Fed funds rate as well as future inflation expectations being higher than what it was 5 years ago, the exact same bond, if it were bought today, would have a coupon rate of 6.35%. So, if the bond that we are looking at in this example were sold today, it would need to be sold at a price where the coupon rate of 4.5% would need to compete with the new coupon rate of 6.35% if that same bond were issued today. Using the equation at the bottom of the screen, we can calculate that the new price that the bond would need to be sold at would need to be $92. This is so that the coupon rate of 4.5% of the original bond is competitive with the new coupon rate of 6.35% if that same bond were to be sold today. So we can see that the price of a bond will go down as its yield goes up, and vice versa, and we will go into this in much more detail in a separate episode. So we can now see how changes to the expected future path for the Fed funds rate, as well as changes to future inflation expectations, can change treasury yields and bond yields. And because there is always a degree of uncertainty regarding where the Fed funds rate, as well as the future inflation rate, will be at any point in time in the future, investors purchasing treasuries and bonds with a maturity date further out into the future will need to be compensated for that level of uncertainty. They'll need to be compensated for taking on that risk. So once we move out the yield curve, i.e. once we consider longer term bonds, investors will need to be compensated for this risk by being paid a term premium. And the longer the term of the bond, the longer the time left to maturity, the greater this uncertainty is. Therefore, the greater the risk is. It is for this reason that the term premium will normally increase over time. Then, for non-government and corporate bonds, we need to include a credit spread, and we looked at this at the start of this episode. We also need to include a liquidity premium, which is the premium an investor will demand to be paid in order to hold a bond which may be difficult to sell quickly at a fair price. But going back to treasury yields for a moment and taking out the credit spread, because there is no credit risk with treasuries, they're seen to be a safe haven asset. Do note, however, though, that treasury yields do contain a small liquidity premium. But by taking out the credit risk, we can see that it is the term premium that causes the shape of a normal yield curve. The yield curve of a bond or treasury is a graph that shows the relationship between the bond's yield and its maturity over time. And because uncertainty is greater the further we go out into the future, resulting in the term premium being greater on bonds with longer maturities, this is what leads us to getting this normal shape to our yield curve. And on this slide, we can see the difference between a normal yield curve and an inverted yield curve. And you will often hear it being said that an inverted yield curve is a strong signal of an oncoming recession. In fact, every US recession going back to the 1950s was preceded by an inversion of the yield curve. There was one false flag in 1966 where the curve inverted, but it wasn't followed by an oncoming recession. But an inverted yield curve had a 90% plus level of accuracy of having predicted these oncoming recessions. And it's worth noting that we've just come through our longest ever inversion of the yield curve. It's also worth noting that historically, the recession normally doesn't start until the yield curve has steepened once again and is now assuming a normal curve slope once again. And knowing what we know now about the composition of Treasury and bond yields, ask yourself the question, why does the yield curve invert in advance of oncoming recessions? Why do investors require higher yields on shorter term bonds than they do on longer term bonds in the lead up to a recession? We will go through this in the second episode, but once again, it's very important to ask ourselves these questions to ensure that we are understanding the bond market fully. And like I mentioned earlier, feel free to leave any answers or questions in the comments below. So now we know how the Fed funds rate as well as future inflation expectations affect Treasury yields and bond yields. And because Treasuries and bond yields are so important, that makes monitoring future rate expectations very important. And following the Fed dot plot is a very good way to do this, as well as listening to the various chairs of the central banks like I'd mentioned earlier. And what's equally important is monitoring future inflation expectations. And when inflation was running hot in mid-2022, I would very closely follow the inflation of the 6 C's: crude, copper, cocoa, coffee, cotton, and corn. I remember one time being out with friends for a Christmas dinner back in December of 2023, and I was sitting next to a friend of mine, and we were both up in arms at how the market all of a sudden were pricing in 7 rate cuts for 2024, starting in March. Neither of us could see where the market got this expectation from. My argument was that this immaculate disinflation couldn't possibly come about because the US had just come off 5.3% GDP in Q3 of that year. So I couldn't see how inflation would come down when the economy was still running so hot. In the end, the Fed only cut by 1% in that year, and all the cuts happened in the second half. But it was due to the monitoring of inflation back in mid-2021 that got me worried about the future of our economy for the first time. Larry Summers, former US Treasury Secretary, was on an interview on Bloomberg television in mid-21, and he said something that made a lot of sense to me. He explained that price is the interaction of supply and demand. This is something I'd known before that. But he had explained that we had just gone through a supply shock at the start of COVID as shipping and trucking of goods around our globe came to a halt essentially. And he explained that if supply caught up again, that supply and demand would come back in equilibrium, and once again we would have no price pressures and inflation would cool down. This was the Fed's thinking at the time also, or at the very least that's what they were hoping. But the bond market saw this oncoming inflation in mid-2021, and bond yields started to rise at that time. I too was very sure that I was starting to see what would stop inflation from being transitory. I work for a company that sells a lot of products and equipment to the construction industry, and I would take a lot of work calls from this window here behind me. And in mid-2021, a very common topic of conversation were the products that we were back ordered on with our distributors, products that our distributors had ordered from us, but we hadn't yet shipped to them. And we would always try and ship the products to our customers as quickly as we could because that's our job. But I would explain back in mid-2021 that even though we were back ordered on products with them, that we had already sent them a substantial amount more products that year than we ever had before. I'd explained that there was a huge demand for everything in construction. While standing at this window here, I'd say that I'm looking at a forest right now. In fact, we're surrounded by trees here in BC. But at that time, if I wanted lumber, it was extremely scarce. And if I could get my hands on some, it was going to cost me 2.5 times what it would cost a year prior. So we certainly had a supply shock at the start of the pandemic. But by now, I was starting to see that we were also having a demand shock. And I was getting worried that even if supply came back to normal levels, that it wouldn't catch up with demand because demand had gone so elevated. And I don't want to go into too many specifics from the point of view of my work, and I don't need to. When it comes to residential housing, the only metric we need to look at is housing starts. And any of us can get those stats from the Statistics Canada website. And in 2021, housing starts went through the roof to their second highest level ever. The highest level was in 1976, and you may remember this from our second episode as we went through the history of new home supply in Canada going back to the mid-1950s. And we saw that the 1970s was a record year for single-attached home starts and completions. And following 2021, 2022 was our fourth highest year ever for housing starts. And this explosion in housing starts, fueled by low interest rates, caused a huge demand shock for all construction materials and for labour in that industry. In fact, low interest rates boosted demand right across our economy, and I was very sure that I was seeing this by looking at the earnings of other companies in other sectors of our economy. And the bond market saw this too. And if you go online, Yahoo Finance offer a very nice interactive chart of the US 10-year Treasury yield. And if you zoom in to mid-2021, you'll start to see that the trend of bond yields was on the upward trend at that time. So even though the Fed funds rate was still at all-time lows, inflation expectations had started to rise. And then at the start of 2022, when the Fed started to increase the Fed's fund rate, now bond yields started to explode higher. Because now we had future inflation expectations as well as the Fed's fund rate, which were both going higher at the same time. So two of the main ingredients in bond and treasury yields were both rising at the same time. And by now, by early 2022, I was getting very worried about the future prospects of our economy, as it was evident that rates would be higher for longer. Because if we look at trends in rate hiking cycles throughout time, we will see that every recession was preceded by a sharp increase in interest rates. It's also worth noting that in the majority of cases, rates had already begun to come down before the recession had started. This is the same chart that we looked at in episode 2 of this podcast, where we linked the trends in new home starts in Canada, and therefore completions, to the Fed funds rate and the overnight rate from the Bank of Canada. So there is a proven track record that increases in the Fed funds rate and therefore bond yields puts strain on our economy. It increases the cost of money and decreases purchasing power as a result. This is what Ray Dalio would refer to as a short-term debt cycle. For anybody who is unfamiliar with Ray Dalio, I could give him a very long introduction and description, but what I'll simply say about him is that he's one of my heroes. In the same way that a devout Edmonton Oilers fan would proclaim Connor McDavid to be one of their heroes. If you're a young boy or girl who wants to excel in sport, or you're an adult who is passionate about economics, you have to have heroes. And Ray Dalio is at the very top of my list. Up there with other heroes of mine like Jeffrey Gunlock, Paul Tudor Jones, Stan Druckenmiller, Leon Cooperman, Jeremy Grantham, Nassim Taleb, the list goes on. And if anybody were to ask me to show them a chart which explains the core of my thesis on why I think our global economy is going to experience some pain, it would be this chart, where we can see that almost every substantial rate hiking cycle throughout time eventually resulted in a recession. It then becomes a question of which sectors of our economy went into this rate hiking cycle most vulnerable. In the last 3 episodes, we spoke about the S&P 500 and US equities overall. And we spoke about how these equity markets are at extremely high valuations compared to the long-term averages. And on the next episode, I'd like to speak about the topic that we started off speaking about when we started this podcast, which is Canadian real estate. And with average home prices to average household incomes at a ratio of 12-1 here in the city that I live in Vancouver, where historically a ratio of 5-1 is considered to be extremely unaffordable, I also believe that Canadian real estate came into this rate hiking cycle in a very vulnerable position, especially in the main hubs of Vancouver and Toronto. And I've been concerned about this for a number of years now. But now I can see other mortgage brokers and real estate podcasters also starting to see the red flags. But I still maintain that they're not fully seeing the weight of the situation. And this is because, in my opinion, they're failing to look at a transaction in the real estate industry in the same way that we looked at a transaction in the bond market earlier on in this episode. They're failing to look at this transaction from the point of view of the buyer. And this became evident to me as I was listening to 2 of my favorite real estate podcasters on a Saturday morning. These 2 gentlemen, who release an episode every Saturday morning, have a very deep appreciation for the data, which is why I very much enjoy and follow their podcast. But one of the realtors said a number of times that even though it's a buyer's market, there's not a lot of buyers. He even suggested that they should change the name from a buyer's market because there's so few buyers. But what this gentleman is failing to do is failing to look at a transaction in the real estate market from the point of view of a buyer. Because if I were your agent and if we were out looking at homes together, would you rather that we go to a home where there's 20 pairs of shoes at the door, there's couples in every room, there's a line of people waiting to speak with the seller's agent? I saw this exact dynamic in 21 and 22, and 'twas no wonder that buyers at that time felt the need to bid over asking on the homes that they wanted. Or would you rather that we are the only people going to view this property? that we have plenty time to take a tour and ask all the questions that we want. And when we're leaving, I would say that if this isn't a property to you, not to worry, there's plenty others. But also, if you'd like to make an offer on this property, I'd recommend that we put in an offer below asking, because it doesn't look like we've a whole lot of competition. When you put yourself in the shoes of the buyer, the answer is obvious. If you are a buyer, you don't want to see other buyers. You don't want competition. So in a market with less buyers, it is truly a buyer's market. And on next week's episode, we're going to focus on the epicenter of the Canadian real estate housing bubble, which is the downtown Toronto condo market. This is where supply and demand are the most out of whack. And we will look at this market from the point of view of the buyer. And this will give us a good feel for whether we believe demand will come back anytime soon or not. And from the second episode of this podcast, we already know the future direction of supply. So if you'd like to see that episode, please like and subscribe, and we'll see you all again soon, hopefully.